All right. Today is Tuesday, March 28th, and this is a recap for the stock market activities today. Now, folks, I got a good one for you tonight. Let's begin with this. We have a banking crisis in this country right now, and we're all waiting what will be the next shoe to drop. But rest assured, the so-called experts and the talking heads, they say that this is not a banking crisis. Instead, it's a sentiment contagion fueled by these YouTubers, the likes of the Maverick of Wall Street, spreading FUD all over the place. I had no idea that a bunch of financial influencers were so powerful on Twitter. They managed to take down Silicon Valley Bank. And I hereby say to all of these financial institutions, I'll stop spreading the FUD if you mail us $1 million apiece. Or better yet, how about you reveal your balance sheets? But folks, these are the same talking heads who told us, don't panic in 2021. A little inflation is not a bad thing. Nobel Award winner in economics, Paul Krugman, said, history says, don't panic about inflation. It's just imaginary. And the New York Times also said, 179 reasons. You probably don't need to panic about inflation. If you have to give me 179 reasons not to panic about inflation, I'm already shitting my pants. And here's the result about don't panic about inflation. We have the largest yield curve inversion in history, indicating that we have a high probability of a massive recession coming. But recently, we got a massive steepening of the yield curve in the aftermath of the, we can't call it the banking crisis anymore. Maybe we should call it institutions with balance sheet challenges, right? But since then, we got a massive re-steepening of the yield curve. And the problem that every time this happens, we have a time of confusion in the stock market. Go back to the aftermath of the re-steepening of the yield curve right before the great financial crisis in 08-09. Go back to the re-steepening of the yield curve after massive inversion in the early 2000s. It's a similar phenomenon. It's a time of confusion because a lot of folks mistaken the re-steepening of the yield curve as the beginning of a new cycle. And we see the stock market rallying for a little bit and then it crashes. And the question becomes, are we at this point right now? Are we seeing the last dance, if you may? And then the inevitable happens, a crash and a recession. But usually, before a crash and a recession, we see another weird phenomenon, which is rampant fraud. A lot of fraud that has been building on since the beginning of the bubble. The fraud starts to come to the surface, and some would argue it becomes the catalyst for the economic downturn and the crash. We all know what happened in Lehman Brothers, for example, Enron before that. And now, as I've told you before, folks, this is the golden age of fraud. In the aftermath of the Great Panic back in 2020 due to the Thing virus, the government opened the spigots of liquidity. Trillions and trillions and trillions of dollars. And fraud ran rampant, be it from the government side, such as the PPP loan fraud program, or be it from all of these cryptos and tulips and SPACs and pump and dump schemes in the stock market, insider sales, Ponzi schemes all over the place. We have seen it all, and now everything is coming down crashing, and it's coming to light. The details about the fraud, the manipulation that has been going on in 2020, 21, all the way to 22. In the morning, we got more details about Sam bankrupt fraud. He's now charged with paying $40 million bribe to China. And then we got the news that we have U.S. authorities are now investigating Binance, one of the largest crypto exchanges in the world. If this one goes down, oh boy, buckle up. We're talking about tens of billions of dollars going poof. And this time around, there are no bailouts because the company doesn't even have a headquarter. And traders are already catching up to this, and they're pulling billions and billions of dollars out of Binance. So here we go. We have another stress going on in the crypto market right now. But it doesn't stop here, folks. Look at the staggering amount of assets held by financial institutions without a banking license. We're talking over $200 trillion. But rest assured, having a banking license might actually make things worse. Take, for example, the Silicon Valley Bank fiasco. Every time we peel the onion, we have the narrative, the story. It was a bank and the Fed raised rates, people went in a bank run, and the bank blew up. But every time we peel the onion, things get more sinister. Things don't add up when you look at what happened in Silicon Valley Bank. To begin with, the rapid collapse of the bank in a matter of 48 hours is absolutely stunning. And to add to that, the rapid pace of the rescue by the Fed, the Treasury, and the authorities authorities during the weekend, right after Silicon Valley Bank collapsed, is absolutely stunning. It wasn't such a huge bank in terms of assets value, for example, to induce panic at the Fed and the Treasury. So what's going on here? Because we know we have a lot of banks that went bust in 2018, 2019, 2020. Not a lot of them were made whole. But Silicon Valley Bank was made whole so fast, you can't help but to wonder why. What was Silicon Valley Bank hiding? We know about the fraud. We know about the risk management, or lack thereof, I should say. We know about insiders dumping shares. We know about bonuses. We know about all of the bad behavior that has been going on in Silicon Valley Bank. But think about it. If you want to run a criminal scheme in the US, there's no better way but to start a bank, a small bank. And you keep your assets just under the threshold from which the authorities and the regulators start applying rules and scrutiny to look in the bank's books, for example. Now, I'm not accusing Silicon Valley Bank of anything sinister, but as you will see by the end of the story, something really, really suspicious is going on here. To begin with, we know that the authorities completely fail in regulating this bank and in spotting the problem ahead of time. Today, Vice Chair of the Fed, Barr, was testifying in Congress, this time around to the Senate. And of course, he blamed the collapse of SVB on mismanagement, and he insisted that all of the problems that were apparent to anybody who looked at the balance sheet of Silicon Valley Bank, these were not apparent until the bank run took place. But isn't it the Fed's failure by designing the rules to allow banks with under $100 billion in assets to escape these regulations and scrutinies? Not to mention, of course, the revolving door in our government, where banksters become government officials and vice versa, and they infiltrate the FDIC, for example. They roll back regulations to make them more favorable for banks to commit fraud. Listen to the exchange with Senator Warren today. Take a look.
That authority is not being used right now. Vice Chair Barr, will you use your authority to strengthen rules for the largest banks in this country? As you use your authority to strengthen the rules for the largest banks in this country, will you be reaching banks with assets of at least $100 billion?
Senator, we, of course, would need to go through a notice and comment rulemaking in this process, but I anticipate the need to strengthen capital and liquidity standards for firms over $100 billion.
Okay. So this is the area we're looking at. We're going to push down further in terms of the greater scrutiny.
Now, this is a major mistake by the Fed because they tailored the rules to apply to larger banks, but not so much to the smaller and medium-sized ones. Now, you might say, but hey, applying the same rules and regulations that we apply on big banks on smaller ones would put them at a competitive disadvantage. I'm not saying that. I'm saying the rules were not even applicable on these smaller or medium-sized banks. There were pretty much very little scrutiny, if any. Continuing.
Chairman Gruenberg, let me turn to you. Once the Fed began torching rule after rule in 2018 for big banks, the FDIC, under your predecessor, joined in on the fun and also started weakening FDIC rules across the board. Capital and liquidity requirements, stress tests, you name it. In fact, your predecessor explicitly told these banks that if FDIC bank examiners were asking too many questions, that they should, quote, let us know, end quote. Now, there's a banking regulator who makes it clear that she is there to serve the big banks instead of the American public. Chairman Gruenberg, will you commit to using your authority to undo the rollbacks that your predecessor initiated and to strengthen the rules and supervision for banks with greater than $100 billion in assets?
Senators, I think you know I was a member of the board at that time and voted against those measures. And I certainly think it's appropriate for us to go back and review those actions in light of the recent episode and consider what changes should be made.
Well, I have to say, review sounds a little wishy here. You didn't think they were good rules to begin with.
My views haven't changed, Senator.
So he just weaseled his way around. He did not really answer the question. Are you going to bring back the rules and regulations that kept the banking system safe? Did not answer that at all. When it comes to the Fed, we know that Jerome Powell absolutely annihilated all the rules and regulations that we put on banks to prevent these kind of problems. We know that Jerome Powell was working on behest of his buddies from investment banking sector. But again, here's another one by Senator Kennedy, another exchange, where he grills Vice Chair Barr on the fact that there was was no actual stress test on Silicon Valley Bank. Not to mention, of course, the whole $100 billion threshold. Take a look.
Senator, I don't have the exact number in front of me, but that
I have your
that
report.
that
I have your
correct.
report. It says 34. And the cutoff was $100 billion. Is that right?
Yes.
Okay. You didn't stress test Silicon Valley Bank, did you?
No, under the Federal Reserve Board's rules that were put in place for transition into the stress testing, it takes a while for a firm to be considered above the threshold. Yeah. They need to have a rolling four-quarter average.
Did you stress test Silicon Valley Bank in 2022?
No.
Okay. Silicon Valley Bank had $100 billion, more than $100 billion in assets at the end of 2021, did it not?
Senator, as I was explaining, the transition rules in place at the time require a rolling four-quarter average to be above that amount.
Okay.
And then if the firm happens to be in a year that isn't the year that, since it's an every other year test, that a test is running, then it waits till the next year. So for Silicon Valley Bank, that would have meant 2024 would be its first stress test.
So again, the rule opens a room for fraud in the banking sector because all what you have to do is use some accounting gimmicks to make sure that you stay below $100 billion, at least for one quarter, so it wouldn't count as a rolling quarter. You can stay over $100 billion for one quarter, then the second quarter, then you move down below $100 billion, boom, you're no longer regulated. You're no longer scrutinized by the Fed. What do you think will happen? You're pretty much opening the room for fraud and scams to happen, for criminal organizations to hide under the banner of being a regional bank, a small community bank. Continuing.
But the point is, you didn't test Silicon Valley Bank.
We did not apply a stress test to Silicon Valley Bank.
Right.
It was, of course, using its own stress test.
Did you have the authority to do it?
Under our existing regulations, no. We would have to change our regulations to have that authority.
Under the Congress's amendment to Dodd-Frank, Senator Crapo talked about it, 2155, Section 252.3. Isn't it a fact that we gave the Federal Reserve the authority to stress test Silicon Valley Bank?
Under that legislation, the Federal Reserve could have put in place a rule defining the word periodic,
but you didn't.
In a different way than was done.
Right, but you didn't, did you?
The Federal Reserve did not do that.
Okay.
And here's the most important part. Even if Silicon Valley Bank was eligible for these stress tests, for example, it wouldn't have made a difference anyway. And the reason is the stress tests are designed by morons who are testing based on GFC conditions, high unemployment, low interest rates, going below zero, etc., etc. When the risk was clearly, they knew, the Fed knew better than anyone, they're going to raise rates to combat inflation. So why not update your stress tests for higher yields? What will happen if yields go higher? Because we have inflation. We knew ahead of time to tackle inflation, interest rates will have to go above the rate of inflation. If I was the Fed chair, I would have said, look, inflation is running at 8% plus. Let's do the test. If we raise rates to above 8%, will these banks hold up? But it shows how the Federal Reserve is arrogant. They never really cease to believe that inflation is transitory. They believe that inflation is just a nauseance, and even if they want to raise rates for a little bit to take it down, they're not going to have to go as far. Maybe they'll go all the way to 1.5%, 2%. This is what the Fed believed, and they thought there's no need to even test for such a scenario because it will never happen. And here we are, right here, right now, with inflation sticking at above 6% and rates now moving higher. They say they're going to cut rates. This is what the market says. They're going to cut rates. They're going to pause, whatever. But is that in the bag? What if rates have to go even higher because inflation is not going down? Are we testing for such scenario? A stagflation scenario? Of course not, because they all dismiss these possibilities as they will never happen. Continuing.
If you had stress tests, let me put it this way. If you had stress tested Silicon Valley Bank in 2022, it wouldn't have made any difference, would it?
I don't know the answer to that question.
Well, you didn't test for Silicon Valley Bank's problem. I've read your report. You stress tested these 34 banks for falling GDP, spike in unemployment, and defaults in commercial real estate. Isn't that correct?
Yes, in a typical adverse scenario for banks, we're testing falling interest rate
But that
environments.
wasn't our problem in 2022.
I completely agree with you.
It's not our problem today. The problem is inflation, high interest rate, and loss of value in government bonds, isn't it?
I completely agree with you.
So you stress tested in 2022 for the wrong thing.
The stress test is not the primary way that the Federal Reserve or other regulators test for interest rate risk.
But you stress tested for the wrong thing.
As I said, Senator, I agree with you that it would be useful to test for higher rising interest rates. That's why in our alternative scenario, multiple scenario that we put in place for this year's stress test, we do that. These decisions were made before I arrived, but I...
Okay, so now he's going to say, oh, these decisions made before I arrived, it's not my problem, it's somebody else's problem. Here we go. The bottom line is Silicon Valley went down and we bailed it out. We made it whole again. We made the depositors whole again. They say, oh, it's the Fed, the FDIC. Where do they get the money? Who funds the FDIC? We know that First Citizens Bank already bought Silicon Valley Bank in a generous deal. To begin with, $56.5 billion in Silicon Valley Bank deposits that First Citizens Bank took. And on top of that, $72 billion in loans at a discount of $16.5 billion. The FDIC also helped finance the deal with $35 billion worth of loan and $70 billion line of credit. It's the most no-brainer deal in history. Why the rush in rescuing Silicon Valley Bank and closing all the books right away, dumping it into another bank where our government is actually encouraging the deal and making it so sweet that it becomes no-brainer? Why? What's there to hide in Silicon Valley books? And of course, we all know there's no such thing as a free lunch. They say don't call them bailouts in this propaganda age that we're living in. What should we call them? We're talking about over $20 billion coming out of the FDIC. Who funds the FDIC? The taxpayer. Charles Payne says, for those that believe there are magic pools of money in the government or banking industry, funds that doesn't come up out of the pockets of regular Americans, time to wake up. Indeed, this is going to cost you one way or the other. Your taxes will go higher. Your quality of living will go down because of cuts and austerity measures that will have to be induced later on to compensate for this. But folks, here's perhaps the most sinister part of the story. Who the hell did we just bail out? Do we even know? They told us it's a bunch of startups, small businesses, mom and pops with deposits over $250,000, and they needed to be made whole. We couldn't just stick it to them. What kind of message would that signal to other banks if we don't save Silicon Valley? Well, I tell you what message it did send. Moral hazard. That you can do whatever you want, you can take whatever risk you want, and the government will come out at the end of the day and bail you out. I want you to listen to this because the question goes once again, who the hell did we just bail out? Here is a former FDIC chair. Listen to what she has to say.
The unanimous vote to invoke the systemic risk exception to the FDIC's deposit limit, was it warranted? Does it set a precedent for future crises?
I think it does. I mean, I think these banks are not systemic. Combined assets of $300 billion and a $23 trillion banking industry. The efforts the statement has been made that, well, they had to bail out the uninsured because they were worried about broader runs. But there's really no analysis to back that up. If that's true, bank regulators track deposit flows. They should be able to tell us what deposit outflows were like during the time period that these banks failed. It troubles me that they haven't provided that type of analysis. The other reason has been that, well, a lot of these startup companies needed access to their payroll accounts. Well, with an advanced dividend, they would have had access to a lot of liquidity anyway, using the FDIC's normal rules without any kind of bailout. And I got to tell you, kudos to Marty Gruenberg, the current chair of the FDIC, for a high level of transparency in his testimony. But he indicated there were $13.3 billion of deposits concentrated with 10 depositors. Those aren't small startups trying to get payroll. And you think about that, they're going to take it, they have about a 10% loss on the Silicon Valley failure. So they're not getting a 10% haircut. So that's $133 million per person. The FDIC, through a special assessment, is paying these very wealthy depositors. I think that's troubling. I do think they need a lot more explanation on this. They did what they did. Listen, I've been there. It's hard to make a decision. It's got to be a snap judgment sometimes. But boy, there's a lot of public cynicism about this, and they need to get more public information out. about why, whether it was needed, were there other deposit runs, and who exactly is benefiting and by how much by the bailout of the uninsured, particularly like Silicon Valley.
I don't know if you caught that or not, but number one, there was no real systemic risk if Silicon Valley Bank collapsed. We just left it at that. But the Fed, the FDIC, the regulators, they bent over backwards in lightning speed to save the bank. Why? Was it really because of systemic risk? Or what about those 10 depositors that she just talked about? 10 depositors in Silicon Valley Bank with an account of over $13.3 billion in aggregate. So we have 10 people, 10 depositors who own $13.3 billion of the deposits of Silicon Valley Bank. The FDIC just spent $20 billion to make SVB whole. Out of that, $13.3 billion just to bail out 10 depositors. Who are these people? Who are these entities? Could it be companies? Well, that doesn't add up. You look at all of these public companies that have deposits in Silicon Valley Bank, which, by the way, we bailed them out. We bailed out Roku. We bailed out Bill Holdings, Rocket Lab, all of these companies, Roblox. We made them whole. But these are not the people with over $13.3 billion in deposits in Silicon Valley Bank. That had to be certain Silicon Valley billionaires who we just saved and made whole. Who are these people? What were they doing before the collapse of SVB? What were their connections to the regulators? Did the collapse of Silicon Valley Bank give them the excuse to avoid certain financial obligations? Were they encouraging a bank run somehow? Were they shorting the bank, for example? A lot of questions have to be asked here. 10 depositors, $13.3 billion. We pretty much bailed out 10 billionaires here. Are we calling this a systemic risk worthy of stopping the fight against inflation because of? We have to pause interest rate hikes now. We have to cut rates to bail out 10 billionaires? Something really fishy is going on here. Something really sinister happened in Silicon Valley Bank and the rescue operation that followed. We deserve all the details. Unfortunately, we're not going to get them, but we're not going to stop looking either. And with that, folks, let's move on to cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average closing in the red, down by 37.83 points, or a decline of 0.12%. The Nasdaq continues to lead to the downside this time around, down by 52.78 points, or a decline of 0.45%. The S&P also in the red, down by 6.26 points, or a decline of 0.16%. When it comes to the sectors, leading the pack at number 1, capturing the gold, metal, energy. Number 2 for the silver, materials. Number 3 for the bronze, cyclicals. And the laggards continue to be communication services and technology. The winners from last week. The losers from last week, maybe not so much for financials, but energy. Major rebound this week. It's not due to short covering, by the way. It's a lot of inflows, billions and billions of dollars buying the dip in energy. A lot of folks believe that there's more juice to squeeze here in the energy rally, despite the fact that futures are actually down. When it comes to the breadth, the NYSE 62% advancing versus 36% declining. The Nasdaq 40% advancing versus 57% declining. And I'm watching the breadth of the Nasdaq because even when the Nasdaq was leading the rally, actually the SPY, the S&P was not really rallying, the IWM was going down. So the Nasdaq was rallying alone. But even when it was rallying alone, the breadth was awful, only led by the big cap technology names. And now as the Nasdaq is leading the declines, the breadth remains awful. You would think, oh, maybe the big caps are the ones who are going to go down and the breadth all in all will not be that bad. No, Nasdaq components are still going down. The big caps rallied for whatever reason in the last 2 weeks, but now they're coming down too. On to commodities. The dollar did lose some ground today, and that initiated some rallies in the commodities cohort, even though the dollar was down yesterday, but precious metals were also down. Today we see them up again. The mystery becomes, is gold and silver rallying today based on the dollar moving down or because of the revival of the recession theme? Well, you have to look at energy to have the answer, and energy says not because of the recession theme. It is actually because the dollar went down. Otherwise, energy would have went down if we have a recession theme. On contrary, we saw the WTI and Brent all gaining ground with about 1% apiece. So did the gasoline RBOB. The laggards, led by natural gas down again, a little over 2.25%. It is retesting the lows from the latest rebound, which was a little below $2. A lot of weakness here in natural gas, not having the momentum to continue to rally. But notice that natural gas stocks are holding a lot better. We'll cover the chart of EQT in the charts analysis, but Heating oil futures were also lagging today, down about half a percentage point. When it comes to softs, we have mixed picture here. Cotton futures leading the rally with about 3.25%, followed by sugar futures up by about 2%, and then OJ futures also scoring gains of about 1.5%. Cocoa futures flattish for the day, and the declines were led by lumber futures down about 3.5%. I guess lumber goes down when we have a beginning of a new expansionary cycle, right? Doesn't make sense at all. Lumber goes down because we have a recession. Coffee also was down by about 1.5%. Muted reactions for meat futures. When it comes to grains, we have muted reactions across the board with sizable gains for soybean meal futures up by about 2.5%, and then soybeans futures up by about 1.7%. Moving on to the options market, the big casino, what do we see here? The volume in the mid-range, not down a lot, but not as the highs that we've seen in the last couple of weeks. With that being said, Tesla, number one with around 1.3 million contracts traded today. Look at this. 60% of the volume was calls, not puts. So we're seeing a lot of bullish bets here in Tesla. The key is holding 180. We'll talk about the chart of Tesla in a minute, but BABA Alibaba number two with around 1 million contracts traded today. About 76% of those were calls. Huge move for Alibaba based on the restructuring plan, splitting the company into 6. I say to each his own. If you want to buy calls and chase the move, go ahead. You want to short it, go ahead too. I'd just leave it alone. The options premiums after such a move, they're not going to be in your favor. Just understand that. The market maker is not going to give you your way here and sell you cheap puts and calls in Alibaba and then lose money. So you got to think like the market maker. Maybe the opportunity here is actually opening credit spreads. Anyhow, number 3 is AMC. We got some rumors today. We're going to talk about them in the heat map analysis, but the name was up big and the volume for options also spiked by about 850,000 contracts today. It's not a surprise that 68% of the volume was calls, not puts. But we do have a battlefield here in the ETF KRE for regional banks. You can see the volume of calls skyrocketed, the volume of puts also skyrocketed, and now it's a battlefield. One of these two will end up holding a massive bag. There is a major move coming in the KRE. My hunch is it will only go down from this point on if we have another shoe dropping, another bank collapsing. Otherwise, call option holders might win here and initiate a short squeeze. A $3 billion ETF tracking regional banks has become the battleground for traders placing their wagers on the outlook of the industry following the recent financial turmoil. Options that bet both for and against the SPDR S&P Regional Banks ETF, ticker KRE, have hit record levels in March, with the fund tumbling almost 30% in the span. Listen to this. Total put open interest, which measures the amount of bearish options activity, jumped to a record of 1.42 million contracts on Friday, up 60% from the day before a collapse in regional banks. Over the same stretch, total call open interest more than quadrupled to 1.05 million, also the highest ever. So we know there is a major move coming here. Maybe playing a straddle strategy would be good, but I would say right now call options holders have the upper hand unless something else breaks. Or let's say we get a hot PCE report on Friday, we see yields spiking higher again. This will bring back fears that more regional banks will blow up because yields will have to go higher. So this is what I'm watching for now. Moving on to the unusual activities that took place in the options market today, we begin with the ticker RIO for Rio Tinto. Somebody sees the name moving higher and they bought the 72.5 calls for the expiration date May 19th, with expectations that the name will move higher and close with gains of more than 10% by then. They paid around $1 a piece to enter this trade, all in all spending around $2 million. And then we have the ticker LNC for Lincoln Financial, an insurance company that went down as regional banks went down, and somebody sees more pain to come. They bought the 17.5 puts for the expiration date May 19th, with expectations that the name will go down and lose more than 16% of its value by then. They paid around $1.25 a piece to enter this trade, all in all spending around $1.2 million. And then we have the ticker LOW for Lowe's. Somebody sees the name moving down dramatically and they bought the 160 puts for the expiration date June 16th, with expectations expectations that the name will go down and lose more than 16% of its value by then. They paid around $2.40 a piece. Standard. This trade, all in all, spending around $2.5 million. And then what about the ticker GOOGL, Google? We're short, and we got paid today, but somebody sees the rebound. We're going to cover the chart of Google, by the way, in the charts analysis, but somebody sees the rebound coming, and they bought the 112 calls for the expiration date, April 28th, with expectations that the name will move higher and gain more than 11% by then. They paid around $1.10 a piece. Standard. This trade, all in all, spending around $600,000. And then what about the ticker GFS? And this is for Global Foundries. Somebody sees the name moving down big, and they bought the $60 puts for the expiration date, May 19th, with expectations that the name will move down and lose more than 10% of its value by then. They paid around $2.50 a piece. Standard. This trade, all in all, spending around $1.2 million. On to the heat map. What do we see here? Mixed picture across the board. A continuation of the weakness in the large caps. It's baffling for now. Are they going to rebound at some point, or are we seeing money coming out of big caps and chasing something else? Certainly not chasing bonds for now, but maybe chasing oil. Look at the rallying energy across the board. Refineries, big oil, natural gas, piping, didn't matter. All of them in the green. We see materials also catching a bid. We see some industrials also catching a bid, along with the Chinese names. So when I look at the theme all in all, when I look at the map, I say, okay, today was a revival of the inflation theme somehow / the China reopening theme. Chinese equities, Chinese ETFs blasting higher. With that comes the demand for metals. With that comes the demand for oil. With that comes the demand from industrials. We see names, for example, such as Caterpillar moving higher. That's all to see today. Nothing major. The volume was low all in all, so we can't really read too much into it. So let's do some corporate news here, and we begin with Lucid Motor. An update for the tsunami of layoffs. Now Lucid is cutting 1,300 jobs because the demand is going down. We also got a report from Micron after hours reporting the largest loss in history. But the CEO says, calm down, nothing to see here. This is the worst is already behind us. This is the peak. And then down we go again. Folks, I'm telling you right now, everybody's chasing NVIDIA, AMD, and even Intel these days. But look at the balance sheets. The inventories are absolutely horrible. They can pump AI all they want, but they cannot even get rid of the inventories they got right now. We have a major problem for chips, but again, mispricing opens opportunities. Somebody buys, takes the price out of whack, that becomes an opportunity for bears to short and make some money. And speaking of the devil, here it is, NVIDIA. Bad news for tulips. Now NVIDIA says crypto doesn't bring anything useful for society anymore. We're done with cryptos. We're gonna pump. AI with no stop inside here. Until, of course, it stops working and the CEO and the insiders dump shares and the stock goes down, doesn't respond to AI anymore, and then they forget about it. Forget about AI. We're back to gaming again. And of course, we got the news for AMC Apes. Massive pump today, and the Apes been asking me for a long time, hey Maverick, the mother of all short squeezes, come on, hop in. I'm like, no thanks. It's not gonna happen. It will never happen. The only condition where a major short squeeze will happen, and it could be rewarding for the Apes, is if Amazon or Netflix buys AMC. Today we got the rumor, not substantiated yet, that Amazon may be buying AMC. And maybe this is good news for AMC shareholders, but bad news for the country, bad news for the industry, because here it is again, one giant consolidating power, owning the movie chain industry. What a shame. For now, these are all rumors. And in my opinion, Amazon has a lot of problems right now. They can no longer afford buying AMC. They're losing a lot of money. They're firing thousands of workers because their margins are absolutely horrific. The shareholders of Amazon will not forgive them buying overvalued AMC right now. And the last piece of news I got for you is from JP Morgan, the Landromat. Now we know that CEO Jamie Dimon will be deposed in the Epstein lawsuit. This will be a big one. And boy, if Jamie Dimon goes down, it's going to hurt JPM as a stock, at least for a little while. And I can't help to wonder, by the way, this whole Silicon Valley Bank, it has an Epstein-y angle to it. You just wait. It's going to come out to light. But for now, let's move on to the ETFs, the heat map for the ETFs, I should say. Muted reactions across the board. Nothing to see here. We have energy moving higher. XLE, XOP, OIH, along with gold miners, GDX, for example. Besides that, nothing to see here. In internationals, we talked about emerging markets and Chinese ETFs. Those are pumping higher because of Alibaba. But again, what's noticeable here is the weakness of large caps. Large caps outperformed the last couple of weeks. Now they're underperforming. And the question becomes, hey, Maverick, if I pull a gun to your head and I say, do you buy the Qs or the IWM right now? If I must, I would say the IWM, and I will show you in the charts analysis. Speaking of, here it is. We start with a bunch of charts that I shared with you in the morning on Discord. In my morning brief, we talked about a bunch of technology stocks. The expectations for this week from the get-go is tech will be weaker, maybe small caps will firm up a little bit. So we see a little bit of a rotation of the performance of the last couple of weeks. But mind you, the valuations, even the forward PE ratios for the S&P information technology remains too high. It is absolute lunacy that the valuations are too high under these circumstances. So we're going to have a reckoning. We know that. The question becomes when. For now, we don't have the answer, so we have to look at charts day by day. We start with Apple, the big kahuna, 4 hours chart. This is the one that I shared with you in the morning brief. And I told you we have support. And if the support is broken, we're going to go down all the way to support number 1, 156.30. And then we take it from there. Here's the update. We got all the way down to 156.30. And then we caught a rebound by the end of the day. So all in all, a neutral reaction by Apple. But I think the damage is already done. And there is more where that came from, meaning we're now bouncing from support number 1, but we take that out and we go down all the way to 153.69, and ultimately, folks, we have to go down 150. Is Apple a short right now? I think you know the answer if you've been following me in Discord. I think it is a tradable short for now, at least all the way to 150. It's up to you. You want to close if it goes down to 153.69. Maybe the chart becomes oversold and we get a rebound. It all depends on your management of the trade. What is your expiration date? If you have a longer expiration date, you can fathom rebounds and you can actually add to your positions based on these rebounds. But if you have shorter expiration dates, you got to be tactical. You got to look at these support lines. You got to close when you have profits, and you don't stretch the trades too far. Here's another one, GOOGL. Google, 2 hours charts. This is what I showed you in the morning. The look, maybe we're going to go down here in Google and form a head and shoulder formation. Now, we've been shorting Google since 105. It's a trade, really. It's not shorting the name, shorting as in, borrowing shares. It's actually a trade. And here's the update. We went down all the way to support number 1 at 100. And we caught a rebound. Now, is it necessary for the chart to rebound and form a right shoulder before it goes down? No, it can gap down tomorrow. But realistically, when we look at the momentum indicators, for example, if we get a rebound, the question becomes we have to watch it and see if it's going to pass, let's say, 102.5. If it doesn't, then it is forming a right shoulder, and down we go. That would be a doubling down signal that 100 is not going to hold as support. That would be an entry if you're not in yet. And I also shared with you this one, 4 hours chart for MSFT, Microsoft. And I pointed out that we have a bear flag pattern with support number 1 as 272.28. Here's the update. We went down pretty much exactly to that support and caught a rebound by the end of the day. Did a lot of damage happen today? The answer is absolutely not. But once we break below 272.28, then we have a technical damage here, at least the beginning off, and the next target becomes 264.20. And here's the last one I shared with you in the morning, NVDA, NVIDIA, 4 hours chart. We identified 260 as support number 1, and then we have a trend line as support number 2. Did not move a lot today, NVIDIA. Here's the update. We went down all the way to 260, retested that support, and then caught a rebound by the end of the day, although not closing above the first 4 hours candle, I should say. So for now, we're seeing some weakness beginning to build up here in NVIDIA. Either the buyers are going to show up in large volumes and keep 260 as support, or 260 is broken, we go down the trend line. If that's broken, then we have 240. And 240 is a good target for short covering if you're entering right now, because the chart will be oversold. Unless you have a longer expiration, then you can use any rebounds to double down, and you take it all the way down to 230 perhaps. But we'll take it one step at a time. And here it is, the SPY, the S&P 500, 30 minutes chart. What do we see here? Nothing happened today. Within range, support 393.58 and the resistance at 398. We're not going to make a major move one way or the other unless one of these lines are broken. If we have a break and a close above 398, then we're going to go ahead and target 400, but really it's going to be 405 in terms of playing call options. If we have a break below 393.58, then the target becomes 385 if you're playing puts, even though we have 390 as support. support, but again, you always go one support line below to make the trade worth it. You can close it at 390, doesn't matter, but if you buy the 390 and it goes down to 390, it's not going to be as rewarding as if you bought the 385. Anyways, here's the daily chart for the continuous contract for the S&P. What do we see here? The volume really low this week. The calm before the storm, waiting for something to happen here. For now, within range, support 3,960 and the resistance, let's say 4,000. The momentum indicators remain neutral/bullish, waiting for further guideline. They can move a little higher if they want, but if the volumes start to show up on the selling side, and this is the highest probability right now, we will see a lot of damage in these momentum indicators and they might actually turn negative. We have to look at the SPX, the cash index, the daily chart. What do we see here? The good news for the bulls above the 200 days moving average. The bad news is below 4,000. It doesn't appear that the SPX has it to close above 4,000. Now watch the 200 days, because if we have a reversal and we close below the 200 days moving average, that will trigger a lot of selling. You will see the VIX spiking up again, and you will see another leg down, a big one this time around with high volume in the SPY. And you can't help but to notice the obvious. What if this is a head and shoulder formation, what we're seeing right here? I'm not saying it will happen. I'm saying there's a high probability that this could be the case. What about the Qs? 30 minutes chart. What do we see here? It did break support, now resistance at around 309, but it remains within range. Now the support 303.30 and the resistance now becomes 309. We can do a retracement all the way to 309 by tomorrow, for example, a rebound rally led by Google, for example, led by Nvidia, led by whoever, doesn't matter. But if 309 is a no-go and we get another rejection, another reversal, then that will be a doubling down signal on the shorts and perhaps an entry if you're not already in. And the reason is you got 309 and has been tested over and over and over again. It should have held as support, yet we lost it. Did anything change from the time that we lost 309 as support and now? Of course not. So if we go back to 309 and knock at the door and say, hey, let me in, 309 would say, do you have any piece of evidence, anything new that you want to show me? And the answer is, for now, not really. We will look at the continuous contract, the daily chart for the NASDAQ. A little bit of technical damage happened today because the support of 12,766 was lost. We see the volume below average, but not moving higher. I'm not talking about the volume, I'm talking about the chart. The volume is down, the chart is not moving higher. Usually that's an ominous sign that once the volume comes back, it will come back on the selling side. We can see that the momentum indicators are kind of weakening here, be it the RSI or the MACD. It looks like it's about to cross, producing red impressions on the histogram indicating that the bullish momentum is over and we have a new bearish momentum. But we'll take it one step at a time. Here's the IWM. When you ask me, I have a gun in your head, would you buy the Qs or the IWM? Looking at the hourly chart, I would say, hey, the Qs already overextended and it has plenty of room to the downside in a retracement. The IWM, on the other hand, an hourly chart already beaten, bruised, consolidating below an important line, 174.22, maybe gathering some energy before it pops higher in a rally that takes us all the way to 180, for example. I'd rather be in the IWM. I wouldn't buy it right now, but if the choice between the Qs and the IWM, I'd go with small caps. The Dixie, the dollar, what's going on here? Lost support once again, 103, and it appears that the dollar is on the trajectory of going down all the way to the next support at around 99.89. But we can't assume that for now until the PCE inflation report is behind us, and that's coming out Friday. If it comes out hot, we could see a rebound in the dollar. If it comes out plain vanilla, then the dollar will continue to go down. And that will be good for who? Good for gold. The old man caught a rebound today. Still overbought, still overcrowded. You look at the RSI, negative divergence. You look at the MACD, kind of stalling here. We need to see negative momentum starting to show up in the MACD and then see how gold is going to hold. If gold start to lose 1928 as support, then 1895, then that's not a good sign. On the other hand, if we see the MACD moving down, producing bearish momentum, red candles, yet gold continues to consolidate within range, perhaps at or above 1928, that would be a bullish signal indicating that gold is really strong and you're going to start buying and accumulating here, because all what it's doing right now is gathering energy to crack above 2000 once and for all. So watch the behavior here. When it comes to silver, SLV, another upside day, and now we're eyeing 21.57, yet the problem remains the same. The technicals are now overextended because we have a massive rally in a short amount of time. The question becomes, will the SLV consolidate below 21.57 or above? Consolidating above, meaning closing above this number and then consolidating while the MACD works itself out along with the RSI, that would be a bullish sign to add the SLV. If we have a consolidation below and we start to trend down by a little bit, not a good sign. And here it is, UK oil, the daily chart for Brent above 77, the magic number. So is oil out of the woods right now? Not even close. oils. I'm still long oil. I'm not dumping any shares right now. I'm hedged. I have a lot of puts, but I cannot say that we're out of the woods. We have to close above 77 by the end of the week. We have to see more and more buying, more and more good news from the China front. We start to see those recession fears subsiding for a little bit. For now, looking at the chart, we can't say that we're out of the woods. And here it is, EQT, a representation of natural gas, better than BOIL, better than UNG, better than a lot of charts that you see in natural gas. This is a weekly chart, of course. We've been waiting and waiting and waiting. When will the crossing happen? When will EQT catch some bullish momentum? It has been under bearish momentum since last October. It's going to happen. It's a matter of when, not if. And that makes the chart attractive for now. And the resistance target would be 35 if the chart crosses above, but most importantly closes above 35 on weekly basis, then we have a major bullish signal here. We could see by the summer natural gas prices recovering and EQT moving all the way back to the 40s. When it comes to the 2-year yield, what do we see here in the daily chart? The bullish momentum perhaps starting here, but is it going to take us all the way to closing the gap at 4.59? Maybe. And that would be a major shock for the market because it's a major repricing. We'll take it one step at a time because for now the assumption should be whatever rebounds we get in the 2-year yield will be transitory. And then we see more declines to follow. That is the rate cutting scenario. But what if we have the rate pause and hold scenario, in which we could see a rebound in the 2-year all the way to the 4.2, 4.5 range, and it sticks there as the Fed pauses rates. That would be bad for equities, bad for banks, and bad for the outlook for systemic risk. And the same goes for the 10-year. We caught a rebound today, got us above 3.5. Can we close by the end of the week above 3.5? That is an important question. And again, can we go all the way to 3.8? Possible. We know that the 10-year is going to start to outperform the 2 at this point when it comes to yields. But the message becomes, is it going to be cuts? And how will the 10-year respond? Is it going to go down based on cuts? That is recessionary. If it goes up based on cut expectations, this means that the bond market is saying that the cuts will be good for the economy, and that supports the expansion theme. On the other hand, if we see the 10-year stalling and consolidating within range, then the bond market is saying the Fed will pause and hold, but it will not cut rates. When it comes to the TLT, a daily chart, what do we see here? Getting closer to 103.5, losing a lot of momentum here, so we're not going to jump in and buy the TLT right now. Let the move in the 10-year plays out, let the PCE get out of the way, and then we'll take a look at the TLT. For now, I see gold and silver as a better play than the TLT. What about the VIX? 4 hours chart, what do we see here? Closing below 20 by a little bit. We know that when the VIX gets to 20, it is a critical point from which we have seen the VIX rebounding higher and the S&P 500 moving down. But what I'm really interested in is the VIX versus the NASDAQ. And I know that we have a volatility index specific to the NASDAQ, but I want to see how the NASDAQ has been behaving as of late in reaction to the VIX. And we have the two charts together, the VIX, a daily chart in orange, and then the NASDAQ in white. And as you can see, every time the VIX went down to 20 and made a touch and go, a touch and a rebound. That was a topping signal for the NASDAQ, and we saw massive declines. And this happened in 2 incidents, by the way. But then, this year so far, for example, we have seen the VIX going down to 20 in a touch and stay, consolidating at 20, a little below the number, and that initiated a rally in the NASDAQ. So which one will it be right now? Will it be touch and go, which means bad news for the NASDAQ, or touch and hold, which could initiate the next leg higher in the NASDAQ? This is what I'm watching for. Tesla, an hourly chart, what do we see here? Every time it catches a bid in the morning, it fades away right away. So we have a lot of weakness here in Tesla despite all of the call options buying that we're seeing. And the reason is not enough volume. We got to see the volume for contracts on Tesla exceeding 3 million for the name to move higher, with about 60% plus of the spread being for calls. Then we see the name moving higher. It needs a little bit of oomph right now to continue this move higher. Otherwise, the bears are waiting. They're stalking right now. They're looking at Tesla. Looking for what? Looking for the name to go down to 180 and then lose that support. That would be a major shorting signal. Otherwise, for now, the bulls are still alive. If they can bring more volume and more energy, they can move it all the way in a retest to 200. But for now, it appears that the momentum on the bullish side is weakening dramatically. And therefore, could this be a reverse ABC pattern that takes us all the way down to 180? Something to think about. Last but not least, what about BTC, Bitcoin, a daily chart? What do we see here? Still maintaining support at 26,555, but losing a lot of momentum here. The RSI negative divergence, the MACDs crossing, about to produce spread impressions and histogram indicating bearish momentum. We're running out of time here. If the buyers don't show up, the holders will become sellers and they will take us down to the next support. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? Not much. We have pending home sales and we have day number 2 for the testimony by Governor Barr. This time around to the House, let's hope for better questions. This time around, maybe better scrutiny. We'll see what happens. This is all I got for you for now, folks. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Take care.
How do you know I'll come back?
Look, Frank, nobody's chasing you.